Managing money well is less about what you know. It's more about how you behave. We often think finance is a hard science like physics or engineering full of rules. But it's not. It's a soft skill where your psychology plays a bigger role than the numbers on a spreadsheet. Understanding this is the first crucial step. You can be a genius with numbers, you might understand complex financial models, you might have read every investing book. But if you lose your cool easily, if you panic during market dips, or get greedy during market highs, that knowledge means very little. Your behavior will ultimately determine your success. Think about it this way: financial success is not always about brilliance. It's often about not making huge mistakes, especially emotional ones. Many smart people make terrible financial decisions not because they lack intelligence but because they lack emotional control. They let fear or excitement dictate their actions. So the foundation of wealth isn't a degree or a high IQ score in math. It's your mindset, your temperament. It's about how you respond to risk, how you manage your desires, how you approach long-term goals. This internal world, your psychology, is where the real financial battles are won. Albert Einstein supposedly called compounding interest the eighth wonder of the world. It's a simple idea, but incredibly powerful. Your money earns returns, then those returns earn returns, and so on, like a snowball rolling downhill. It starts small, almost invisibly, but given enough time, it becomes an avalanche. Warren Buffett is a household name, often cited as the world's greatest investor. But his real secret isn't just stock picking, it's time. He started investing as a child. He's been investing for over 3/4 of a century. The vast majority of his fortune was accumulated after his 50th birthday. That's the magic of compounding over decades. Buffett's story teaches us a vital lesson. Patience is a profound financial virtue. He didn't get rich quick. He got rich slowly, consistently. He let his investments work for him through good times and bad. He understood that time in the market is far more important than timing the market. Most people underestimate the power of time. We want results now, instantly. But true wealth building is a marathon, not a sprint. It requires discipline. The discipline to save regularly, the discipline to invest consistently, and the discipline to wait. Patience allows compounding to work its wonders. As your income grows, something subtle happens. Your spending habits often change too. A slightly nicer car, a bigger house, more expensive holidays, more frequent dining out. This is known as lifestyle inflation, or lifestyle creep. It's the tendency for your expenses to rise in tandem with your earnings, making it hard to actually build more wealth. Lifestyle creep is a sneaky thief. It quietly steals your potential savings. You work harder, earn more, but you don't feel much richer because your outgoings have expanded to consume that extra income. The goalposts for financial comfort keep moving further away, just out of reach. The danger is that you get used to it. The new, higher level of spending becomes normal. It becomes your baseline, making it harder to save, harder to invest for the future, and it can create financial fragility. If your income suddenly drops, you're left with high expenses you can't sustain. The key to overcoming lifestyle creep is to be conscious of your spending and to make deliberate choices. When you get a raise or a bonus, resist the urge to upgrade everything immediately. Instead, aim to save and invest a significant portion of that increase. True wealth is the gap you create and maintain. Section 4. Emotional tides, navigating market swings with a steady hand. Financial markets are, well, like the ocean. Sometimes they're calm and serene, and other times they can be wild and stormy. These fluctuations are, a normal part of investing, but they can wreak havoc on our emotions and consequently on our financial decisions. When markets rise sharply, greed can take over, and when they fall, fear can become overwhelming. Emotional biases, they're powerful forces. Fear of missing out, or FOMO, pushes us to buy assets when they are expensive simply because everyone else seems to be profiting. Conversely, panic selling occurs when markets decline, locking in losses, often at the worst possible time. These actions, they're driven by gut feelings, not logic. The ability to remain calm, it's like a superpower, especially during periods of market volatility. When others are panicking, a cool head prevails. This doesn't mean being emotionless, it means acknowledging your emotions but not letting them dictate your actions. Sticking to your long-term plan is crucial when the financial seas get rough. History shows us that markets recover, but emotional decisions can cause permanent damage to your financial well-being. The best investors understand this. They cultivate emotional resilience. They have a plan, and they stick to it. They don't let short-term noise derail their long-term financial journey. Section 5. The long view: why slow and steady wins the financial race. Everyone loves, the idea of getting rich quick. Finding that one stock that explodes or perfectly timing market peaks and troughs. The allure of fast money is strong. It's a narrative sold by many but achieved by very, very few. Attempting to time the market consistently is often a fool's errand, even for professionals. The reality of successful investing is usually far less exciting. It's about patience and consistency. It's about adopting a long-term perspective. Understanding that wealth is built gradually, not in a sudden burst of luck or genius. This means focusing on time the market, rather than trying to perfectly the market. Think of it like planting a tree. You don't dig it up every few days to check if the roots are growing. You plant it in good soil, you water it, give it sunlight, and you let it grow over many years. Investing for the long term is similar. You make sound choices and let them mature. This approach requires discipline. The discipline to keep investing even when markets are down or when they seem too high. The discipline to ignore the daily noise, the hype, the fear-mongering, and focus on your own long-term goals. Slow and steady truly does win the financial race. Section 6. Your own path: defining wealth on your terms. We live in a world of constant comparison. Social media shows us curated highlights of other people's lives, their successes, their new cars, exotic vacations, big homes. It's easy to look at others and feel like you're falling behind or that your own achievements are small. This comparison is a dangerous trap. Comparing your financial situation to others is often a recipe for unhappiness and poor decision-making. Someone will always have more than you. Someone will always seem luckier. Chasing someone else's definition of wealth will leave you perpetually dissatisfied because their goals and values are not yours. The most important financial question is personal. What does enough mean to? What kind of life do you want to live? What brings you genuine contentment and security? Is it freedom from debt, the ability to pursue a passion, spending more time with loved ones? Financial goals should reflect your deepest values. Your financial journey is unique. Like your fingerprint, it's one of a kind. Success shouldn't be measured by external benchmarks, but by your own progress towards your personal goals. Define what wealth means for you. Create a plan that aligns with that definition, and run your own race at your own pace. That is the path to true financial peace. Section 7. The inner game. True wealth is self-mastery. Building wealth isn't just about numbers or sophisticated investment strategies. At its core, it's about simple, consistent habits: saving a portion of your income regularly, investing that money wisely for the long term, avoiding unnecessary and high-interest debt. These are the foundational pillars upon which financial well-being is built. These habits might seem straightforward, almost too simple to be effective, but their power lies in their consistency. Small, positive actions repeated over years and decades create remarkable results. It's not about making one brilliant move, it's about making many good, sensible moves over a very long period of time. Ultimately, financial success is an internal game. It's less about outsmarting the market and more about outsmarting your own impulses, your own biases, your own fears. It requires self-discipline, patience, and a clear understanding of your own psychology. Knowing your weaknesses can be a strength if you build systems to counteract them. Mastering money, therefore, is a journey of mastering oneself. It's about controlling your desires, managing your expectations, and making decisions aligned with your long-term good. When you understand that your behavior is the most critical factor in your financial life, you unlock the true secret to lasting wealth and contentment.